Over the past decade, home prices across the country have been rising at unprecedented rates. In many urban areas, prices have doubled or even tripled compared to 10 years ago. This growth has made purchasing a home increasingly difficult for average families. One of the main drivers of rising prices is the imbalance between supply and demand. There are simply more people looking to buy homes than there are homes available, which naturally drives up the cost. Populous cities like San Francisco, New York, and Seattle have seen extreme price growth, pricing out first-time buyers. Middle-class families are often forced to consider smaller homes or move to suburban or rural areas. Bidding wars have become a regular feature of the housing market. Multiple buyers competing for the same property often push prices far above listing values. This trend has made it almost impossible for buyers who cannot act quickly. Remote work has added to the problem, as people relocate to cities with better job opportunities. Housing demand has surged, further inflating prices. Neighborhoods that were previously affordable are now seeing rapid appreciation. Limited availability of starter homes exacerbates the problem. Many new constructions are either luxury apartments or expensive single-family homes, leaving little inventory for typical first-time buyers. Rising prices also increase property taxes, which adds to the cost of homeownership. Buyers must account not only for mortgage payments, but also for taxes that rise with property values. The result is that even households with stable incomes may find themselves unable to compete in high-demand markets. Savings are depleted faster, and the dream of homeownership is delayed or abandoned. In short, skyrocketing home prices are a fundamental reason why buying a house has become nearly impossible for many Americans until supply catches up with demand or prices stabilize. This trend is likely to continue. Mortgage rates have been climbing steadily in recent years, making homeownership significantly more expensive for buyers. Even a small increase in interest rates can add hundreds of dollars to monthly mortgage payments, straining household budgets. Higher mortgage rates reduce the amount of money a buyer can borrow. A home that might have been affordable a year ago can suddenly become out of reach due to increased financing costs. This rise in rates has been fueled by central banks' efforts to control inflation. While necessary for the economy, these measures make borrowing more expensive, especially for first-time buyers. For many prospective homeowners, the difference between a 3% and a 6% mortgage rate can translate to tens of thousands of dollars over the life of a loan. This reality often forces buyers to reconsider their options or delay purchases. Refinancing has become less attractive as well. Homeowners who previously locked in low rates can no longer take advantage of cheaper financing, limiting market mobility and reducing the overall number of homes for sale. The psychological impact of rising rates cannot be ignored. Buyers may hesitate to enter the market, fearing even higher rates in the future, which slows overall home sales and contributes to uncertainty. First-time buyers are particularly affected because they typically have smaller down payments and fewer savings. Higher rates further reduce their purchasing power and may push them into renting longer in competitive housing markets. Rising rates also exacerbate bidding wars. buyers willing to stretch their budgets and up paying even more, making affordability an even greater challenge. Ultimately, rising mortgage rates are a major factor in today's housing affordability crisis. Even families with solid incomes may find themselves priced out, illustrating how interest rates can directly shape who can and cannot buy a home. One of the most pressing issues in the housing market is the limited supply of available homes. New construction has not kept pace with population growth, leaving fewer options for buyers. Labor shortages and rising material costs have slowed home building projects. Especially in urban areas, builders often focus on luxury homes, which are more profitable, rather than affordable starter homes. Many existing homeowners are staying in their properties longer, reducing the turnover of homes for sale. This further limits supply and increases competition among buyers. Low inventory drives up prices because buyers compete for a small pool of homes. Even modest properties can sell above asking price, creating an environment that favors those with more resources. The shortage is especially acute in cities with high demand. Urban centers attract job seekers, but zoning restrictions and limited land prevent sufficient construction to meet growing needs. In suburban and rural areas, supply may be slightly better, but rising demand and migration from cities are quickly pushing prices upward there as well. Developers face regulatory hurdles that delay construction, permitting processes, zoning laws, and environmental restrictions can add months or even years to a project, reducing the number of homes entering the market. Limited housing supply also affects renters, as competition for rental units rises alongside home prices. This makes saving for a down payment even harder, creating a cycle of unaffordability. In summary, the scarcity of homes is a central reason buying a house has become nearly impossible. Until supply increases substantially, the imbalance between demand and availability will continue to challenge prospective homeowners. Rising costs of living have placed significant financial pressure on potential home buyers. Everyday expenses like groceries, utilities, and transportation have increased, leaving less money for saving toward a down payment. Inflation has eroded purchasing power, making it harder for families to accumulate enough savings for a home. Even moderate wage increases often fail to keep pace with rising prices. Student loan debt is another major factor. Millions of young adults carry significant loans, which reduce their ability to qualify for mortgages or save for a down payment. Healthcare costs also impact potential buyers. Unexpected medical expenses can derail financial planning, making it difficult to maintain the stability required to purchase a home. Credit scores play a crucial role in mortgage eligibility, but economic pressures can lead to missed payments or increased debt, which lowers credit worthiness. Lower credit scores increase interest rates, further limiting affordability. Job insecurity in certain sectors has made buyers hesitant to commit to long-term financial obligations like mortgages. Even those with stable employment may delay home purchases due to uncertainty. The combination of high debt and rising living costs forces many first-time buyers to postpone purchasing a home. Renting becomes the default option, even if it offers no long-term equity or stability. Some families attempt to buy smaller or less desirable homes to cope with economic pressures. But this often results in compromises on location, size, or quality. Overall, economic pressures create a barrier to homeownership that is as significant as high prices or low inventory. Without broader financial relief or wage growth, many families will remain priced out of the market. The rise of investors in the housing market has made it increasingly difficult for ordinary buyers to compete. Institutional buyers often purchase single-family homes to rent them out or flip them for profit. These investors can pay in cash, making it harder for traditional buyers to secure properties through conventional financing. This drives prices higher and intensifies competition. Flipping houses contributes to market volatility. Properties are purchased, renovated, and resold at higher prices, often beyond the reach of first-time buyers. The presence of large investment firms in certain markets has further reduced the availability of homes. Neighborhoods that were once accessible to middle-class families are now dominated by rental properties. Short-term rental platforms like Airbnb have also encouraged investors to buy homes for temporary rentals, removing them from the long-term housing market. Investors often target high-demand areas, which exacerbates local housing shortages. This trend pushes communities toward more expensive housing and displaces long-term residents. Speculative buying can lead to inflated market valuations. Even small increases in demand from investors can cause price jumps that outpace wage growth. The focus on profit rather than community need means that affordable housing projects are often overlooked or underfunded, worsening the crisis. Ultimately, investment and speculation in real estate make it difficult for everyday families to compete, creating a market where ownership is increasingly limited to the financially privileged. Government policies and local zoning laws significantly impact the housing market. Restrictive zoning often limits the type and density of housing that can be built, slowing the creation of affordable homes. Many cities have rules that favor single-family homes over multifamily units, reducing the availability of apartments or townhouses for lower-income buyers. Lengthy permitting processes further delay construction. Developers face bureaucratic hurdles that can take months or years to navigate, keeping new homes off the market. In some areas, rent control policies discourage developers from investing in housing, limiting supply even further. These regulations, while protecting renters in the short term, can reduce long-term affordability. Government programs designed to help first-time buyers often have strict eligibility requirements or limited funding, making them inaccessible to many families who need them most. Infrastructure and utility requirements can also increase construction costs. Developers must meet strict standards that make projects more expensive and reduce incentives to build affordable units. Local opposition or NIMBYism, not in my backyard, often blocks new development projects. Even when they could alleviate housing shortages, community resistance slows growth in key areas. Lack of coordinated federal, state, and local policy further complicates housing development. Inconsistent rules make it difficult for developers to plan large-scale affordable housing projects. In summary, policy and zoning challenges significantly restrict housing availability and affordability. Until regulations evolve to encourage more development, prospective buyers will continue to face an uphill battle in today's market.